Hello, fellow investors. I'm screening restaurant stocks. This time, I'm doing 4 stocks, namely Shake Shack stock, WingStop stock, Cheesecake Factory stock, and Jack in the Box stock. 3 stocks to avoid and 1 stock I'd recommend buying. Which of the 4 is that stock? This is SHAK valuation summary, SHAK. Everything here looks, I know, it's because look at the EPS trailing 12 months. It's all negative. If not negative, it's very little. So if you ask me just by looking at this, I'm not a buyer of the stock. More to that, look at their financials. Free cash flow is negative. They're burning your money. This is a Netflix stock, and I'm not a buyer of Netflix stock. Why? No cash flow. That's it. What are we paying if they're not profitable? Their potential? I'm sorry, but I'm a conservative investor. I'd rather lose money on companies making actual money. Look at their margins. Negative, low, just not the combination I'm exactly looking for. I don't even know what margin to use here, to be honest. I don't think looking more beyond this metric is needed. I mean, just this, I'm sold. I'm not a buyer of this stock, and I'd recommend you to. Don't lose your hard earned money on this stock. Maybe one day, when their financials get clearer. I mean, the company is growing their revenues 30-40% yearly. So I guess it's going in the right direction, just not now that it's priced in years of growth already. Shake Shack could be selling the best burgers in the world, but with their numbers, their financials, I don't think it's worth $1.85 billion market cap. Although, look at this. PB ratio looks attractive, 4.35. Current ratio looks attractive as well, 3.07. But still, I'm not buying. I don't recommend buying just yet. Guru Focus says its intrinsic value is 3.68. My fair value is not even $1. It's not even by much. My entry price are not even at $1. I'd put this on my avoid list. Next is Wingstop. Wing. This is their valuation summary. It's overvalued by these metrics. Guru Focus agrees, negative 2.62 intrinsic value. I have a fair value of $16 though. High entry price of $15. Let's look more into Wing. EPS is really low. Although increasing, the PE maybe is just too high. Their margins are high, at least compared to Shake Shack. Their margins are ranging from 8 to 16%. At least, no, better than nothing. Price to free cash flow is very high at 90. I like this below 20. No PB ratio. So, in case of liquidation, you get nothing of your money. High current ratio though, 1.89. Overall, I think this and SHAK are growth stocks with high growth expectations. Look at their revenue growth. I mean, it's very high. 15-30% yearly. That's impressive. Very high numbers, but again, overvalued. If markets don't like growth stocks, I think this has more room to the downside, even if it's 61% off the highs. So yeah, I don't recommend buying this stock either, but at least it's worth something, just not by much. I'd put this stock on my avoid list. Next stock is Cake, Cheesecake Factory. It's overvalued by this metric. High EPS multiple, 14.55, trading 8.64 times their margins, and 1.77 price to free cash flow to PE ratio. Although the price to free cash flow is attractive, 11.99. My fair value for Cake is $3.59. It's low. Intrinsic value is 27.83. This is from Guru Focus. So this one is interesting. We'll look more into this. I have a high price of $7 for cake. EPS is so low now for cake. Well, at least compared before at 3.27 here. Maybe it's because of the shares being diluted, or the net income just isn't increasing, or it's even decreasing. If we use 3.27 here, the multiple is still too high, 6.5. So let's try putting 3.27 here. $8 fair value, not by much. So nothing's changed drastically from $4 to $8. So it's still very overvalued compared to the current price. 13 million shares diluted to shareholders. That's bad. Margins are low, playing around 2 to 5%. Price to free cash flow, interesting though, only 11.99. I could be in it for a trade. PB ratio is attractive at 4.59. Current ratio is not good though, 0.62. Strong cash though, they're virtually debtless. Anyway, I still think cake is overvalued. I don't recommend buying for the long term, although maybe for a trade, maybe swing trade, bring the price to free cash flow back to normal PE levels. Now, this fourth stock, is the buy of the four. This is trading around fair values. This one I'd recommend buying for long term, or perhaps adding into existing positions. If you own Jock in the Box, I suggest adding around at this price, $70. That's my fair value. High price of $74, but intrinsic value is only 7.29. This is from Guru Focus. I like Jack in the Box among other stocks, because look at their multiples, 1.37 times EPS multiple, increasing EPS, decreasing shares, 43% of the highs. Their margins are considerably high, playing around 8 to 14%. Although I think their revenues might have capped. That's why I use 40% margin of safety here. Price to free cash flow is very attractive as well, 9.31 only. Trading below their margins with dividends discounted. Historically cheap, some bad here. No PB ratio, that is bad. Low current ratio, 0.59. Very high debt. Poor cash, but all in all, I think Jack stock is worth more than 1.49 billion market cap. I think investors are not sitting well with the PB ratio with the stock. I'd understand, but I think as they continue to grow, this should improve. I have a hold rating right now. Not essentially buy, but compared to the other three, this is a buy for me. My only problem for Jack is the EPS. Look, you can you can see the jump from pre-pandemic levels, 3.84 up to 7.37. So this is good growth in EPS, but is it sustainable? That's my only worry about the stock. If you're confident with them still increasing their EPS, I think the share price could sustain. This is the summary for all four stocks, so you can decide for yourself. Among the four stocks, I'm going with Jack in the Box stock. Let's look at their charts. 58.67 for Jack is 3% dividend yield. If I'm being true to myself, that would be my entry price if I'm being strict with my rule of dividends. 3%, 4%, 5%. Anyway, I think this year is good for Jack. and we don't want to buy into their strength, but this could be a start of something good for Jack. So if you're okay with dollar cost averaging on Jack stock, then it's time to buy this stock around these prices. So yeah, that's my take on these four stocks. See you on my next video.